Welcome in everyone. Today is an interesting video. We've had the markets kind of going crazy since the beginning of the year, really, especially if you're a software name or anything close to a software name. As you can see, we're back in fear in the fear and greed index. Let's hop over and look at the heat map. This is for the year to date. As you can tell, tech getting sold off like crazy. Even Microsoft down 15%. PLTR, one of the best earnings I've ever seen from any stock. It's getting crushed, down 22. Oracle's down like 70% from highs. The semis are down. Nvidia's down 6%. You have some of like Micron, some of the build out stocks or the memory stocks or storage stocks for AI are benefiting, but a lot of the like Broadcom, AMD, Nvidia, they're being sold off. You have software getting hammered. Look at the biggest software names. Intuit down 33%. They're down like 50% from highs. ServiceNow, same thing. Salesforce, same thing. Adobe, hammered. It was over $600 a share not too long ago. Now it's under 300. Uber's getting hammered. ADP, everything in software is getting hammered. So we're kind of transitioning from tech and software. The software trade, we're going from the high margin businesses. Everyone's moving into consumer defensives. Google's holding up very well. That company is just a powerhouse. It's one that probably would be selling off if they weren't doing so well. You have some healthcare was bouncing back. And then you also have like the entertainment, Netflix, Disney, Warner Bros. They're all getting sold off this year. Even Tesla's getting a bad bid. So we're kind of going into defensives. At least the market is for the first month of the year so far. So yeah, it's been really crazy. I decided to go shopping today. I made a lot of changes to the portfolio. Not really changes, but I made a lot of adds. So I had I had 7 shares of Google, and I had, I believe, 12 shares of VOO, the S&P 500 index, in my Roth IRA. And I decided to liquidate both of those because I saw so many opportunities. Google had been holding up. It's still my, let's see, 4th biggest position after selling off 7 of my 24 shares. Now I'm down to 17. So it's still a really big position for me. But I just see so many deals. The software names are getting sold off so bad. Big tech, some of the best business models in the market are being sold off like crazy to start the year. So I see it as a big opportunity. Today I added 1 more share of Meta. That company is just set up so well for the future. That moat is insurmountable. It's trading at a realistic multiple. It's like a 21, 22 forward PE. Even the free cash flow yield isn't that bad considering how much they're doing in CapEx spend. So Meta's a great buy for me. It's now my 2nd biggest position. It'll probably pass Adobe, honestly. Adobe's probably going to... I wouldn't doubt if Adobe goes under 250 in the short term, but I'm continually adding to Adobe. Every time it drops, I'm just adding. I think that company's great. I added 3 more shares of Adobe today. I brought my average down from like 347 to 341. So I'm just slowly chipping away at my average. This company will be over $600 one day, I believe. I haven't had it added to MasterCard. That was my buy throughout the beginning of the year. And Q4 of 2025, I was adding a lot of MasterCard. Like I said, I sold off from Google. Duolingo stock is getting hammered. It was like a $600 stock at one point last year in the summer. Now it's at $110 per share. I added 10 shares of Duolingo today. I brought my average down from 200-ish to 176. So that company, everything is up and to the right. We'll take a look here in a minute. I added a share of S&P Global today. Everyone's scared Anthropic's going to be joining the rating agencies now. So it's going to be a triopoly, or Anthropic's probably just going to take the whole business away from them. That's what the market thinks, at least. So I added 1 share of S&P Global. I think it's a powerhouse. I don't see the company going anywhere. The moat is insane. I'm now down on position. I was up like 10% a week ago. Kind of crazy turn of events. Toast being sold off like crazy. I added 25 more shares. I really improved my position here. I had 50 shares. Now I have 75. We'll take a look at that one here in a little bit. Uber. This is a new position for me. A stock that's been on my watch list since the beginning of last year. I almost pulled the trigger around $60, and I just had other opportunities at the time that I was chasing. One of them is right here, this beautiful company named PayPal. great opportunity it was. But anyways, Uber added 25 shares, right around $75 per share. The earnings report was great. The company is just printing free cash flow. The growth is, they're expecting accelerated growth in trips. This company's on the right track. Spotify, another company I've wanted to own for probably 3 years now. One of the first companies that I started following. They never hit profitability for years. They finally did, and the stock just ran away from me. Now it's being sold off. Supposedly AI is going to be replacing Spotify and any other music app. So Spotify's down nearly 50% from highs. I got 4 shares at 460. Unfortunately, and it sold off another like 4% after I bought my share. Yeah, down 4%. No big deal. I'll add some more shares if it continues to drop. PayPal, I added 2 shares the other day after that earnings report. The earnings report wasn't that bad. They got rid of the CEO. I think that's the biggest thing. I was kind of critical of a few things he did. Doing way too much with a business that is not going to return to 10% plus growth rates. I thought he should have focused on the buyback and the efficiencies instead of hiring Will Ferrell for ads and making acquisitions and stuff like that. The company's they have way too much competition. This is honestly a stock that doesn't fit in my portfolio, but at this point, it is almost impossible to fail at $41 a share. There's almost no way that this company has negative returns from 41 bucks. I could still be in the negative, but I think it's going to cut away some of my losses as I'm down 40%. Intuit, another position I added today. This is probably one I'm going to continue adding to. I've wanted to own this stock for so long. A lot of you know this company, Credit Karma, QuickBooks, and of course TurboTax. The company, I got lucky on my buy here. I guess a little bit of Spotify push and pull here. Intuit is up 6% since I bought it this morning. I got incredibly lucky there. No big deal. I'll probably continue to add around these prices as I put more capital in the account. But Intuit is a powerhouse. It's growing like 18% per year right now. The stock-based comp was an issue for years. It was just following the free cash flow and the revenue growth, but now it's flattened out over the past 2 years or so. So this company's set up for success. This software is not going anywhere. No one's switching away from their QuickBooks. No one's switching away from Credit Karma or TurboTax. I think Credit Karma is an amazing business, by the way. It's probably my favorite business of the 3. They have 4, but of the 3 main ones. And then Robinhood. Nothing new here. I'm still holding my shares. I bought at the April bottom. I probably should have sold them when it ran up to 150 bucks. I wanted to so bad, but I wanted to avoid paying the short-term capital gains taxes. Now the stock has been chopped in half. So I was up 300%. Now I'm up 142%. No big deal. It's a really small position. I almost bought none of the company, really. I mean, I'm up 140. I think I bought like 700 bucks of the company. Maybe even less, but the company's fine. Now it's honestly fair value for the company, I think. So I don't think it's a super wide company. I will end up selling this one. I probably should and just pay the short-term capital gains, but I hate holding a stock for under a year. I wanted to see it run. Maybe it'll rerun up until April. Maybe we get back over 100 bucks per share. I'd be happy to sell at that and pay long-term capital gains. And then Netflix, another one I'm going to continue adding to. I added 5 more shares today. I added 10 about a week or 2 ago. When I started the position, my average is now down to basically 80 bucks. It was 81. So yeah, we have some big changes here. And then the rest of my portfolio, I don't have it on here. It's like 23% of my total portfolio is in SCHG now. That's in my Roth IRA. So nothing to see there. That's going to stay the same. But yeah, now we're up to 13 stocks. We've added 3. We've added 4 this month. Hopefully we're going to get rid of Robinhood and PayPal in the somewhat near future. I'm not going to say sell PayPal under 40 bucks or under 50 bucks. I will honestly, if we see some of these software names run away from me, I will add to PayPal. It's just not the best buy in the market right now, but it is so undervalued. It's trading at like a 7 EV to free cash flow. So if the company doesn't die within 5-6 years, it will be a successful investment at this point. But yeah, I wanted to hop over to Twitter. I want to show you guys a clip of something that Jensen, the CEO of NVIDIA, the AI company, what he said about the software sell-off recently. So let's take a listen here.
You just give us your top of mind on physical AI.
Remember what software is. Software is a tool. There's this notion that the software industry is in decline and will be replaced by AI. You could tell because there's a whole bunch of software companies whose stock prices are under a lot of pressure because somehow AI is going to replace them. It is the most illogical thing in the world, and time will prove itself.
Most illogical thing in the world. I'm not going to listen to this whole clip, but basically people are saying that all these software companies are going to go to zero. They're going to be replaced by AI. So basically, what they're saying is that if Anthropic, which is what has made the Claude what is going crazy right now, they're saying it's going to take over software. Anthropic would be, $100 trillion market cap now because it's going to take over every business ever, pretty much, is what we're saying now. And here is the CEO of the biggest company in the world, the face of the AI race, NVIDIA, and he's basically saying that software is going nowhere. You could watch the clip. I reposted it on my Twitter. The link for that will be in the description. But that's why the pivot in the market is going from these great software names into companies that aren't even like AI companies because they don't know where to put their money because it doesn't make any sense. It's an illogical rotation from software and big tech into Walmart or, just something so defensive, waste management. Like those stocks are just because they're safe from AI. We're not going to invest in AI. We're not going to invest in software because AI is going to kill both. So I think this is a complete overreaction. I think if the rotation into the consumer defensives weren't so heavy, we would see the market down 5, 10, maybe even more right now. I think we're seeing some better opportunities today than we were in April last year. And I was doing everything I could to buy stocks in April. So I had to load up. Let's take a look. Let's take a look at some of the stocks I bought. So here's Intuit. This is just real simple. We'll take another look at the fundamentals of this company are up and to the right, and they're actually accelerating over the past year or two. Here is the forward EV to free cash flow mixed with the stock price. As you can see, it's down to 18 forward EV to free cash flow. So the enterprise value compared to next year's cash flows or the next 12 months free cash flows, it's only 18 times. So the last time it dropped down here was November of 2016. Look at the stock price then. Obviously, it was undervalued. It hasn't even came close to $100 since then. Other times that it's dipped, you can see here it's 21 or 22 pretty much, which is significantly lower than that now. But if you bought it here at the 220s, 201, it's not even close. This is just so uncorrelated to the stock price. Software would truly have to die for this to be a bad investment at this point. I mean, short term, anything could happen. This thing could go under $400. We could see 350. I don't really know. Markets are crazy in the short term, but the free cash flow per share is going to keep going up and to the right. At least I think so. Over time, this will be a $1,000 stock one day in my eyes, and I'm able to buy it here in the lower 400s. So obvious nosedive on the valuation for no reason. Let's pull up the free cash flow here. Yeah, per share. Free cash flow per share. We'll make it. Let's get rid of these. It's up and to the right. Where is the AI disruption? It better come. If not, the bears are going to be really sad about missing out on this one. It's literally straight up and to the right. It's almost a perfectly straight line. So let's take a look at another company that I bought today, Uber. Like I said, this one's been on the watch list for about a year, a little over a year actually now. Once again, I have the forward EV to free cash flow and the free cash flow per share pulled up. As you can see, free cash flow per share. Let me do free cash flow per share CAGR 110% since Q2 2022. Obviously, that's unrealistic, but still rapid acceleration. Let's see over the past couple years since Q2 2023, 95%. This is the last 6 quarters, 61%. So this company is printing cash. They have more levers to pull in the future. They have deliveries growing like crazy year over year, as well as trips, and they expect trips to accelerate in 2026. But as you can see, it's not the cheapest forward EV to free cash flow that we've seen. I think down, April, right on Liberation Day, pretty much, we saw it down to 12, which is insane. But I feel like we've kind of cleared a little bit of the air. Back last year, the beginning of last year, people really believed that Tesla was going to be the player. But I mean, they hardly have anything on the road. I don't even know if they have fully unsupervised robotaxis in Texas yet. I saw one, but it had a car following it still. So Waymo has taken off. So there's obviously going to be multiple players in the autonomous vehicle race. And I think that is just very, very bullish for Uber. The only way I saw them being disrupted is if maybe Waymo got all of the business, or if Uber got all of the business, or Zoox, or if any one player dominated the race. It would have been really bad for Uber, but their network is so crucial. Even Waymo is like relying on them in certain locations. So the fact that AVs are most likely going to become commoditized, I see this as being a steal deal. We have free cash flows compounding at insane rates. Revenue's up like 20% per year. And we're getting it at a 16 forward EV to free cash flow, which is cheaper than Intuit. So as long as we don't get disrupted, which I honestly think, I think it's more likely that AI disrupts software than it is that AVs disrupt Uber, which I guess you could say AI could also disrupt Uber's network. Not going to happen. It's impossible. I believe I saw something today that they provide rides to 95% of the United States. So there's only 5% of the land area in the United States that you can't get an Uber ride at, which is unbelievable. They've reached insane scale and they finally hit profitability, and it has taken off like a rocket. All right, third company I bought today. This is Spotify. We're trading now at a 22 forward EV to free cash flow on this one. Cash flows are explosive. After they hit profitability a couple years ago, they have just been pulling all their levers for profitability, increasing operating margin. They're kind of slowing that, and they're focusing a little bit more on acceleration of user growth, which they have so much more to go. I think they have 280-ish million subscribers, and they have a lot more active daily active users that aren't subscribers. So they still have penetration to hit. They still have market share to capture. They are the biggest player. But there is competition with this one. I think it's a lot less likely that we see any kind of AI disruption with Spotify. I highly doubt it's going to happen. It is an addictive product. I love it. Everyone loves it. It's got networking effects to where they have like the combined playlist. If you want to share songs with people, it's kind of awkward. If you both don't have Spotify, they have Spotify Wrapped. It's like a whole cultural event. I love the mode of this company. I think it's very underrated. People think it's a high quality company, but they don't believe it has a true moat because Apple Music and YouTube Music and all these things are comparable services. But I think Spotify is really building up their moat, especially every year that they grow their scale. I think the moat just gets even stronger. So this is one that, let me get rid of these last few quarters because that is a little unrealistic for the free cash flow growth. We'll actually just do like here's like 6 quarters. Free cash flow per share is growing at 136 CAGR. That's not going to happen, but I truly believe that we could see this one grow above 20% for years. And we're getting a steal deal on the valuation ever since they've hit profitability back 2022, 2023, back in 2022. This is the lowest valuation we've gotten other than right here. We had a steep dip. I'm not really. Let me look at the share price here. What was that looking like here? Was that a big dip? It must have been a big dip in free cash flow expectations or something. It's kind of strange, but nonetheless, you get the point. The valuation has nosedived. 2025 we were at a 43, 44, 41 in the beginning of. I mean, back here, Liberation Day, where were we at? 30 forward EV to free cash flow. Now we're down to 22. Significant deal. If you don't believe this company is getting disrupted by AI, it is a great deal today. I want to do a DCF for all 3 of these. Let's pull up Spotify. Let's do a bear case. Right now they're trading at a 3.8 yield. That's way too low, or sorry, way too high, which is way too cheap. Let's say if they can get 25% growth and they get a 3% yield, which is realistic if you have 25% free cash flow per share growth. you're going to trade around a 3 yield unless you just have an eroded moat or something, which I don't see happening with Spotify. You're looking at 30% CAGR. 5 years from now, you have a $1.6 thousand share price for Spotify. Unreal in my mind. That would be like a, sorry, I said that was going to be a bear case. That's more of a bull case. This is a bear case, 15% growth. I'll even go down to 10. 10% growth, 4 yield, which is realistic. Maybe it trades at a 4.5. This is the worst I could see Spotify growing at this point. If their free cash flow per share growth slows below 10, something happened. Someone took market share. AI disruption of some sort happened to the music business. That or it gets a really, really bad bid in the market. 4.5 yield is it's more than fair for 10% growth. 10% growth is not bad. And we'll say a base case is right around 15% growth and a 4 yield, which is beating the market 13%. So I would even argue this is closer to 18, but 15 is just to be safe. So I think Spotify's a great buy. I don't see anyone losing money at this price in the long term. I don't know what's going to happen in the short term, but let's take a look at Uber. For a bear case, let's say, Waymo is dominating and they're taking some of their customers away. Man, I don't even know. Oh, let's say they grow at 10% for the bear case and they traded a 4.5 yield. You're getting 20% returns, which is phenomenal, which is fair. If you're growing free cash flow per share at 12%, you're going to trade it at least 4.5 free cash flow yield, unless you have, like I said, something seriously going wrong. If the business is in decline at that point, you might trade at a 5.5, maybe a 6, but it's going to be short term. Let's look. If you traded a 7 free cash flow yield, 12% growth, you're beating the market. So I think 18% is a base case. You can grow. We'll give it a 4.2 yield. You have 28% CAGR, insane. And there's a chance we could grow at 25%. They find efficiencies. They accelerate like they're projecting to. We're going to trade close to a 3 yield. It could even trade down to a 3. I'm not going to give it that. Let's say it trades at a 3.5. So you have a bull case of 41% returns for Uber. I mean, I just have to buy the stock. It's too cheap. I love the direction of the company. I love the moat. The scale's impressive. High margin business. It's beautiful. And then Intuit. Let's see what we got here. They've been growing revenues at 18% and accelerating, especially through Credit Karma, which is an insane. It's such a great business model. It's like a three-sided network effect, but very impressive nonetheless. Revenues growing at 18%, stock-based comp flattening out. I think for a bear case, I mean, this is bad. We see 10% free cash flow per share growth. Maybe Claude takes half of their customers. Obviously, if they take half, this will be in the negative, but Claude's eating away at their market share or something. I don't know. Whatever they think the AI monster is takes away some of their market share. 10% growth. We'll trade at a 4.5 free cash flow yield. Even if it's a 5, we're what, flat? Still positive return. Obviously, this is bad. This is a really bad bear case. And then base case, they've been growing revenues at 18%. I think base case, you've got to give them free cash flow per share at 18%, with a yield of. This company usually trades higher than this, honestly, but I'm going to say 3.5 for the base case. You're looking at an 18% CAGR, which is great. 5 years from now, the shares are over $1,000. We could see this trade down. Sometimes it trades into the 2s, but 3% you get really good returns. For the bull case, let's say they continue to accelerate. AI helps the business, as it should. It helps their operations, helps their margins. We see 24% free cash flow per share growth. We see the yield come down to 2.5. You're looking at 33% gains per year. Share price 5 years out is $1.8 thousand per share. You're getting this at $4.50. I've got to buy this one. All these companies are a buy. Honorable mention, just because I get so many questions about this company. It's my biggest position. Adobe. The valuation is so cheap. The market thinks this company will, like, within the next year, it will stop growth. Like, it'll be flat or declining. And they're growing free cash flow per share around 16, 17, 18% per year. So let's play a bear case. Let's say 6% free cash flow per share growth rate. That means they have 0% free cash flow growth because they're buying back 6% of the company every year. 6% free cash flow growth rates. You're going to trade probably around a 5 yield. This is a bear case. I mean, the market's giving an 8.5 yield. That is so overblown. It's unreal. AI is not taking over. We're not going to have AI Super Bowl ads. We're not going to have AI movies. That's not going to happen. There's going to be personalization in the professional realm of marketing and content creation. It's not going away. It's not going to be fully AI. It's not going to happen. AI is in the Adobe software systems. It's here to stay. With my ultimate bear case here, we're having a share price over $500 in 5 years, which is great returns. Base case, I see steady growth from now. Let's say 15%. That's going to give you a 4 yield all day. You're looking at 27, 28% returns over the next 5. Shares are close to $1,000 there in 5 years. All right, for a bull case, maybe let's say that the pricing model goes from per seat to a productivity model, being able to charge more, each customer more revenue per customer. Let's say that the content creation space grows overall, as it should be. It's been growing for probably 30 years straight now. It should continue to grow. Let's say they continue to fight off Canva and Figma on the lower end, which is only about 25% of their customers overall. So let's say we get 20. This really depends on how low or how long the stock stays low, because they're buying back so many shares, which helps their free cash flow per share growth rate. Every quarter they get to buy back more shares. So if this continues to trade low and then eventually the market wakes up down the road, we could see 22% free cash flow per share growth rate. You're going to trade at close to a 3. We'll give it a 3.5. Just because the market's sour on it, you're still getting 40% returns. This is steep, but it is very possible. They're growing at like 16, 17% today. This is 5% increase on that. So very, very possible. You're looking at shares selling for $1.5 thousand 5 years from today. You're getting this under $300. This company is a buy. Do your own due diligence, but I am very confident in Adobe. That's why it's my top pick. It will stay that way until I see something change. I started buying it almost a year ago now, a little after. It was, I believe, May or June. I bought my first share of the company, and I've just been DCAing all the way down. They haven't shown me anything to make me not believe in the business. I like the direction they're headed, so that's it for that. Adobe's going to stay in my top position. New additions, I'm probably going to continue to add to Netflix, Intuit, Spotify, Uber. I might even add a little bit more Duolingo, as much as I don't want to. It's too big of a position already, but the stock is too cheap. The projections are too great for that one. I'm gonna stay on track. I'm gonna take what the market gives me. I'm gonna continue to work, put as much money as I can in the market as I see great opportunities. And I see a lot of stress right now on X, Twitter, whatever you want to call it. People freaking out. They're down 20% on the year because they're in software stocks or high-tech stock, big tech stocks. Whatever the case may be, I just want people to know that this is the time to really slow down, take a step back, zoom out, look long-term, stick with the same strategy, buying businesses that have strong competitive advantages, that are set with organic growth, that have tailwinds in their sector. Don't stray away. Don't go bargain bin hunting. Don't look at companies because they're cheap. Look at companies that you know are great. And once they turn cheap, then you buy in. All of these companies that I bought today, these 3 companies, they've been on my watch list for a year, I believe. All of them at least. Yeah, all of them have been on my watch list for at least a year. The market finally sold them down. I was looking at Intuit in the 600s. I got to buy in at 424. I was looking at Spotify at 600. I got to buy in at 460. I was looking at Uber in the 80s. close to 90. I got to buy in at 75 after the free cash flow per share growth and the revenues have continued to grow. So be patient. Don't freak out. Don't sell just because the market's going down. And don't go buy companies that you aren't confident in, that you don't know much about, just because they're cheap. I see a lot of companies that I've been recommended to, like Constellation Software, ServiceNow. I looked at them. They look really cheap. I haven't dug into the business enough for me to personally invest in them. So stick to what you know. Keep a small watch list. Over and over, go over these companies. Weed out the bad ones. Weed out the ones that don't match your thesis, that don't match your criteria for investment. Stay level-headed. We're going to be just fine. Software is going to be fine, I think. So that's it for today, guys. Thank you all for tuning in. I hope you all have a good day. Thank you.